What's going on, guys? Welcome back to today's show. I like doing these live streams now. There's something a little more fun about the live engagement, the live audience. We are excited to have you guys back for another Money Moves episode. There's definitely been some money moving over the last
up and down and up and down and up and down and up and down.
Yeah. The last week was definitely with some volatility, stocks, crypto. I wish I could say there was volatility in real estate. Like I want some dopamine in real estate. I need some. The only volatility that I get in real estate right now is watching the fucking 10-year treasury just keep
rates.
going.
Rates are volatile. Yeah.
Well,
tough.
We're going to dive in on all of that today. I made a post earlier this week. The days of buy and hold real estate and getting wealthy as a real estate investor, they're over. They're dead. But you can still make money in real estate. But just like any winning strategy, it doesn't play out that way forever.
Mm-hmm.
And based on the world changing, technology changing, obviously there's a lot going on with the Fed changing, just overall, the way the markets move. You got to adapt and pivot. So we'll talk a little bit about that today. We've got some updates on the Iran war because it's on. It's back on. It's spicy. So we've got some updates there. Obviously, that's definitely impacting the stock market.
Mm-hmm.
That's not as much impacting crypto as I thought it was going to. Crypto seems to be shrugging it off right now. So we'll talk about that a little bit.
Some other catalysts over there, I think, maybe right now.
Yeah, which there is a big catalyst. I think that I'll get your thoughts on whether or not maybe some capital is front-running what they think is coming here in the very near future. And we'll talk about how the Clarity Act and where that stands is going to impact the crypto markets going forward. Have we seen a bottom? Do we have brighter days ahead if you are a crypto investor? And do we have brighter days ahead in the stock market? We got earnings season right now. We've got, obviously, the Iran war, what's going on with oil. Rate probabilities have updated as of, kind of the escalation taking place this week. So we'll look at you. Look at you over there. How you feeling about all that?
It is what it is. It's part of investing. Volatility.
Part of investing. So we got a lot to dive in on today. Why don't we just start with where the overall stock market is at based on
it was great today.
How the Iran conflict has escalated once again. I think I even saw on, let me see if I can pull up Unusual Whales, but from what CENTCOM was showing and Trump's posts, we've got the escalation picking back up. We've been bombing Iran for the last 4 or 5 days pretty aggressively.
Bombing them again.
They've been bombing us back. There were some unfortunate casualties of U.S. military service members, I believe in Jordan.
Jordan is what I heard, yeah.
And that obviously pissed Trump off. There was a lot that has gone on behind closed doors of potential deals and discussions. Tone, you can pull this up on the screen here. So let me see if I can find this. So from what I'm seeing, Trump is rapidly running. Okay, so that's not. Where did that last post go? But basically, we're supposed to continue bombing them as of today.
Yeah, they're probably
within the next couple hours.
Yeah, 2 hours are probably going to be finished because they're a few hours ahead, and then they're going to make a post and probably declassify the videos of what happened. And I'm like trying to think of where are they bombing?
Yeah, supposedly we've crushed all their infrastructure. We've crushed their military. Their navy's at the bottom of the sea. All their leaders are dead. At least that's what we've been told. And yet we're still bombing, ideally, infrastructure, things that, weaken the Iranian regime. Trump put up here, I believe today, he said, Iran wants to meet. We have no interest. Trump says they will be hitting Iran very soon. Of note, U.S. CENTCOM has struck Iran for 9 consecutive days, so not even 5. The Iran war has restarted. So there's obviously lots of headlines swirling around the Iran conflict. We've got crude oils sitting around, I think it was at 84 last we checked. Projections are showing that so we got 84. Projections are showing that maybe it'll get back up north of 90 by the end of the month. What else did I see on and how that's kind of...
I just don't think oil is reacting as much as it did last time, nor do I think the market is as reactive as it was last time. In fact, I would say it's not as, because today the market was up a ton on the back of earnings, which I think people are just weighing what's important and what's not important. And, you know, bleeding hearts are great, but bills are due. So people want to be making money. So stocks making money is more important. The market shrugged off pretty hard the Iran conflict over the weekend. And we have huge names reporting this week that I think is going to overweigh anything that's going on in Iran. I just think, like we were talking about last week, people are just starting to just become normalized and not as...
It's kind of how it seems like with all the conflicts, right? I mean, you had Russia and Ukraine. I mean, a lot of these are market-moving manipulation kind of narratives that it's just the way the markets move, right? Like, we like to see markets go up and see markets go down, and that's why we've got a lot of talking heads on the screen that love to pronounce and amplify a lot of these narratives. But it does seem, too, at the same time, that smart money is also making their bets and holding firm in a lot of areas. I mean, we're 150 basis points off of the S&P 500, hitting an all-time high again.
Yeah.
I think we've hit how many this year?
Tons. I don't know.
Over a dozen. I know that.
Easily, yeah.
And so I know a lot of the people that have been somewhat, let me, be cautious and wait until some of these conflicts cool down a little bit to make the next move, or ultimately watching. I mean, you've missed out on all those all-time highs if you were just sitting on the sidelines. I was talking with a buddy the other day, and this was 2 years ago, mind you. And he's much more conservative, but he's got a multi-seven-figure portfolio. And he's like, I'm going to sit on the sidelines. Like, the market, the talking heads, the news, the mainstream media, they do such a good job at stoking people's emotions. And this is why you always say, just you don't invest based on emotion. Mm-hmm. He's been sitting on the sidelines for 2 years. And he was like, I'm kicking myself because I've missed out on a lot of gains. Now I don't feel like I can or should get back in because I'm buying at all-time highs. And it's just a great reminder of, like, there's always going to be some conflict, some mainstream news outlet that spooks you or gets you excited. And that's why you just can't get too high, can't get too low.
Can you pull up something that I sent on your messages? I was actually going over this with one of my clients the other day about volatility and kind of why it's important that we have a plan and we stick with it.
Yeah, you can throw us on the screen, Tone.
And if you go down to the...
And for those that aren't watching the live stream, so it says missing top performing days can hurt your return. This was done by BlackRock.
Yeah, so this is January 2002 through December.
And this is based on a hypothetical investment of $100,000 in the S&P 500 index over the last 20 years.
I have a more up-to-date one that is going to show similar data through 2024. But if we go down to the graph that essentially shows, if we can zoom in on that, I don't know. Can we zoom in on that? A little bit.
Where you want me to go?
Essentially what it says is that orange graph right there shows the person that stayed fully invested. So they have $616,317. The graph to the right shows $389,264. That's 5 days out of the market. 5 of the best trading days. The graph to the right of that, 282,358. 10 of the best trading days, and so on and so forth. The point of this is not to say that you need to be more aggressive or anything like that, but this is one of the reasons once we get a plan established, we really stick to it, because we cannot constantly jump in and out of the market and miss upswings like today. A lot of people I know went to cash over the weekend. They put sale orders in and liquidated as kind of like exit liquidity. And what those people forget is that the reason their stocks are selling, the reason that they can put those trades in, is because on Monday they're gonna fill, and they're gonna go to big institutions and big funds. And that's what we saw today. I saw a ton of retail volatility on the futures, and then I saw big funds and firms buying up all of it, the likes of Schwab, the likes of Vanguard, the likes of Fidelity, and buying it at a discount and getting a quick 1% move up. I'm watching after hours, and small caps and micro caps are still rallying really hard, which is indicative that it's probably going to carry through to tomorrow. If we have good earnings from the big names, from which is like IBM, Texas Instruments, Google, if they report strong, Tesla, if we get strong earnings, especially from Google and Tesla, that's really going to push the market forward. And I would say probably have a really strong week in the head of any sort of Iran conflict news.
It's funny because we as humans are just emotional beings. I find you're really good at this when it comes to the world of investing and just in general, right? Like just you're pretty slow and steady, baby. You just, nothing gets you too high, too low. Most of the most successful investors I know, or the most successful business owners I know, they know that they're going to experience peaks and valleys. Like it's just like, I have to hardwire this into my brain because we're all human. Mm-hmm. We all have emotions. I know I'm going to have peaks and valleys, and yet I have to find a way to keep my default at the middle equilibrium and just following the plan of moving one step in front of the other. Because I saw a post on X today, and I think it applies whether it's to entrepreneurship, whether it's to investing. It's like one day I feel like I'm taking over the world. Literally the next day I feel like everything is crashing. Yeah. And that is, I mean, that's investing, that's entrepreneurship. I think that's just life in general, right? Is like things can feel heavy and dark and scary and wild one day, and the next day you're like, I'm fucking invincible, man. Like nothing's going to stop me. But that's where you have to like fall back on the default practices and habits and disciplines, and just trusting that what you're doing is going to work itself out if you keep doing the small things consistently over a long period of time. Yeah. And whether it's entrepreneurship or it's investing, like that's something that I consistently have to keep reminding myself. I mean, how many times do I hit you up? I'm like, hey, you know, da-da-da-da happened. Like, aren't you worried about this? You're like, no, not really, da-da-da, right? Like I'm victim to it all the time. And I consider myself a pretty even-keeled, like, I guess in the world of real estate, I'm a little bit more like that. But I think for a lot of people that are stepping into uncharted territories that they haven't been in before, if you're trying to take a step up in business, if you're trying to take a step up in your income, a step up with your investment portfolio, like, it's a new level. Like, and new levels sometimes require you to retool some of your skills or your relationships or your capital, your wiring. But I think most importantly, like, you have to just remember, like, the person who is steadfast, because every level has some storm, some challenge, some issue that's going to pop up. Sure. But it kind of reminds me of like that lighthouse analogy. Like, there's always going to be storms that come and go, but like the lighthouse just stays sturdy no matter what. Mm-hmm. And so I think that's a good reminder, especially in times like right now when you've got, you know, big conflicts going on around the world and things feel scary and they get, you know, kind of played up. You just got to fucking keep it cool, man.
Yep, ride the lightning.
Ride
the lightning.
Fucking Zeus over here,
man. You just got to grab a hold of it and not let go. It's kind of scary. It can be. Even I get, you know, nervous as investing.
Yeah, when do you get nervous? Because I don't ever see that side of you. Like, what ruffles your feathers every once in a while, or gets you like, oh shit, like, what? Well,
I don't like it when my phone's blowing up for stuff that people know that's gonna happen. That will more so piss me off and be like, oh,
yeah, but that's not like worry.
But worry? I don't know. Not a ton. I mean, I got pretty thick skin in the market now. I've been doing it for over a decade. So seen a good amount of stuff in the past. Going in my 11th year now, there's been a lot of market cycles in that period of time. So It's just a part of investing. I think the thing that people do a lot, including in real estate, is they pick their risk tolerance or how they feel about investing, whether it be commercial, single family, stocks, what have you. They pick their risk tolerance in an up market or a bull market, an upswing.
Yep.
And they don't really digest, like, if I'm going to get, this amount of return, I got to take this amount of risk. And nobody really digests the risk part of it and just looks at the return part of it. And I think that's one of the biggest fallacies. You have to know that you should expect a higher rate of return with higher risk assets, just like you should not expect a higher rate of return by taking less risk than a higher risk asset, right? Your beta has to be in line to get a higher alpha. You have to have a higher beta typically to drive a higher alpha out of your assets.
Yep.
So for me, when I look at that, I say, why do people forget that they're risking a lot? And then I think about the casino, Look at people that win on a slot machine. What do? They take their winnings and go jam it through another machine because they have hot hand fallacy, which is really what it is. I think I'm going to continue to win. I think I'm going to continue to win until I don't, and I'm risking so much that I lose it all. That's a very common denominator in why Vegas makes a lot of money on sports betting.
Round trip.
Exactly. So to me, that's again why when I work with most of my clients, we typically just go on, I tell them, I don't know how much rate of return we're going to make. We can project it. I don't know if we're going to make that, but I know how much risk we're taking.
Yeah.
Like I know what we're risking up front, and that's really more important because I don't get called a lot when we make clients money. Their accounts are going up, but they stress out a lot when they see volatility. And even if I've told them, a lot of people forget about it. Like risk freaks people out more than not making enough money. But maybe that's a better way to say it.
Yeah.
Nobody's like, oh man, I only made 13% and the S&P made 15. Let me get completely out. No, but people will say, man, the S&P lost 30 and I lost 33. I need to get completely out and go to cash. That same 3% spread, but it's on a loss, and it freaks people out way more.
Yeah.
So that's my job, is to educate people on the amount of risk they're taking and make sure they can meet their goals in accordance to their risk. And that it's hard for people to do that. So people on both sides, and that's why a lot of real estate investors have failed and have been failing in the past couple years. They wrote their pro formas for no rain.
Yeah.
As you've mentioned multiple times. And that's expecting it to be better than it is all the time. That's too optimistic.
Yep.
And that's the same thing in the stock market. It's like looking at a linear rate of return on a stock investment. Unrealistic. You're going to take losses.
Yeah. I think you have to have, like, as an investor, you have to have a healthy level of paranoia, but not to the place where it paralyzes you from taking risk.
Yeah. Analysis paralysis is a real thing. You can't have that, but you also can't just go full retard on anything. I mean, you just can't do that. Are we allowed to say that? I think that word is back again. But
well, in our context, we're using it right.
Yeah. I'm using it in like the Tropic Thunder context. You can't just go haphazardly into something and say, "Oh, I'm not gonna fail, so I'm going to be successful, and there's no option to failing, so I'm going to do it." Sure, you could win, but you're most of the time going to be unsuccessful. A better thing to do is like what you were saying. Maybe we were talking the other day on the insurance loan.
Yep.
Hey, the current cost is this, but it's like 0.5% off the max cost. So if I was you, I would just bake in the max cost of the pro forma.
Yep.
Nope. That's probably a good idea.
Yeah.
Because then it's an error in your favor.
And I'm going to go take that risk, and I'm going to live with where the
Exactly.
the chips fall, baby.
Exactly. And it's just better to assume the worst and not get it than to say, I'm kind of nervous to anticipate that, so I'm just going to act like it's not going to happen. That's just not a realistic way to invest in anything.
I'm curious, too, for those that are watching or listening, like, how do you guys look at risk? Because obviously everybody looks at risk differently, right?
Mm-hmm.
I mean, the guy that I was just telling you about, he felt like the market was too risky 2 years ago, and he's missed out on 2 years worth of gains,
60,
right?
70% in gains, yeah.
I mean, I was talking with an investor the other day, and they were like, man, I feel like now is the worst time to get into real estate investing. Like, rates are high, prices are high. It's really hard to make, deals pencil. And I couldn't help but smile a little bit. Like, they felt like it was way too risky. And I couldn't help but smile because when I got into real estate investing, it was 2010. It was 2 years post-financial crisis.
Yeah, I would say.
Banks were failing. People were losing their jobs. People were losing their houses. Foreclosures were everywhere. When I was telling people, like, I'm going to take a risk and get into real estate investing, everybody was like, dude, you're crazy. Like, you should just wait for things to calm down.
Follow the crowd, Matt.
And, yeah, follow the crowd. And looking back in hindsight, if I would have done that, I would have never started flipping houses. I mean, I remember I went to TJ Maxx and I bought a blazer, and I told myself I'm going to look the part and I'm going to take the risk going into being a real estate investor. 15 years later, TJ Maxx is now one of my anchor tenants in my shopping center. And if I would have just never decided to take that risk, like, I wouldn't be telling that story today.
Yeah, no, I have a couple of those in my back pocket too. I'm like, whoo, those are nerve wracking, but the growth zone is always that way because
For sure.
you don't have any, you have no, I've never been here before. I'm growing. I'm getting bigger and better, so I don't know what this is like. It gets really scary, and then sometimes it's hard because in those moments, typically you're by yourself. You're leading the charge. You're the tip of the spear.
Yep.
It gets a little bit scary sometimes when you have to do those things.
Well, now you have to take risk if you want to build real wealth.
Yeah.
I saw on Unusual Whales the other day, 556,000-ish people worldwide now have a net worth exceeding $30 million, which is up 14.4% in 2025 and 2026 alone, making it the fastest growth since 2017. This was an article they released out in Wall Street Journal. And those people didn't gain or accelerate their net worth by making that up and earning more. It's because they invested and they owned assets like businesses, real estate, stocks. So it's almost like now if you want to build wealth, you can't out-earn in a way to build real wealth. Like, you have to find ways to get on the ownership side and being on the equity side of real businesses, real investments, because the world that we're living in, whether it's inflation or it's economic variable shifting, you're going to get real benefits and upside without having to do a lot of work by being on the ownership side versus just trying to make more money.
Yeah, it's equity, or it's either selling your time or obtaining equity. And I think that's really what it boils down to a lot of the times. I mean, there's little finite ways to kind of be fickle with that, but I would prefer to have equity versus selling my time, because my time is worth more and more every day versus, if I have equity, equity can earn and compound for me, and I can use my time elsewhere.
Have you noticed any of your risk tolerance changing at all as you've gotten later in life, or now that you have a son?
Personally?
Yeah, because I know a lot of people say, like, when I was younger and it was just me, or when I was younger and I didn't have kids, or, there's always there's an interesting psychology of how risk shifts over time for people. Yeah. I think once you make a lot, it becomes more about protecting more of it versus earning more or growing it as aggressively. So I can see and understand that side, but I'm just curious of, one, your perspective on that, or two, how you've noticed that with clients' portfolios getting to a certain level. Do they decide to shift and, kind of reallocate their portfolio based on the risk and the season or the stage they're at in life? Like, how do people assess risk in your world, and how should they be looking at risk based on how much they should or shouldn't be taking?
Well, me personally, I haven't cranked down my investment risk just due to my,
But your income has been growing too, pretty solid, right? So you can keep taking more risk if you're not necessarily as worried about your income staying the same or going backwards.
Well, and I'm also, my investment account, I'm putting that money there so I can live off of it. So I'm not living off of it right now.
Yeah.
And I try not to take money out of it really ever. Maybe here and there when I have a really big year. Like last year, I took a little bit of hair off the top or something like that. But I kind of treat my brokerage account like my retirement account. So I put money in there for my retirement. So no, I mean, even if my income went down, I would still put in the same amount of money and I would still have the same risk tolerance. I think when I get, 5-ish years to the point where I'm ready to really live off it, I might crank down my equity exposure by 5 or 10%, but I don't think I'll ever go below 85 or 90% in equities. I think right now I'm like 98, 97% stock. If you look at my overall, I have about maybe 2% in bonds and cash. So I know it. I know it's going to go down, but I know it's going to really, over a long period of time, go up. And I have the stomach for it.
Yeah.
If you understand it, it's not scary. It's like a 1031 exchange your first time versus your 10th time. You know, it's a lot scarier your first time doing something like that versus your 10th time. To me, I'd be more scared not making the money.
Yeah.
I guess the thing that I think about it most is, do I want to worry about my money for 1 year or 1.5 years while it's going through volatility, or do I want to think about it for 7 years while the market's ripping and I'm watching it sit there?
Right.
I think I'd be more worried for 7 years. So I think how we look at volatility, it's really how much are you willing to like lose in a percentage. If we're looking for really high rates of return, are you willing to lose 30% in a year? Is that too much? Okay, well, you may want that part. You may want the upside of it, but you can't have your cake and eat it too.
Yeah.
If you're going to deal with the up, you have to deal with the down. If you can't deal with the down, we got to crank it down a bit.
Yeah.
You're going to give up some upside, but because you don't want to deal with the downside. And a lot of people they're like, well, I want, volatility of low returns, but I want returns of high risk.
Yeah.
I don't want that
disconnect there.
Yeah, so that's a really hard one to translate to people. But the other thing I always tell people is you don't really have to make crazy rates of return to be successful. The most successful investors that I've worked with were just the best savers. They constantly saved. So whatever they were investing in, even if it wasn't making them the most amount of money that year, it was compounding.
Yeah.
And so that ultimate, because real estate's not a home run hitter by any means from an annualization point, but it always makes more over time than the mortgages that are issued on them, or else they wouldn't issue the mortgages.
Yeah, 100%.
So to me, the same idea can be said with retirees. We don't need to make 20 or 30%. We can make high single digits, low double digit rates of return and withdraw against it and be very successful and not have to stick their neck out. It's just capitalizing that account, which is really the other big difference between the two, is leveraging into real estate versus capitalizing an investment account.
Yep.
Both work similarly, but it takes a lot more time to capitalize the account with cash than it does to leverage against the cash.
Yeah, 100%. I was saying that same almost. So in your world, with how you're talking about risk, was same conversation I was having with that guy the other day. I'm like, if you think it's so risky right now to invest in real estate, you don't have to do the deal 100% by yourself. Like, you can mitigate risk by bringing in more partners. Yeah, you make less. You're going to dilute yourself in terms of how much you can capture on the upside, but you're still going to get exposure to it. You're still going to get the benefits of the cash flow and the equity appreciation and some of the tax advantages. And that's okay, right? Like, that's the beauty of real estate, is you can be like, hey, I'm going to do this deal by myself when you feel very confident and you're very risk, heavy in your appetite. And other times when you feel like, hey, prices are a little bit high, or margins are a little bit lower than I'd like to see, or the rates, I'm not as certain about what direction they're going to go. Cool. Doesn't mean you have to 100% stop doing deals. Obviously, you don't want to do a bad deal. But if there's a deal that you feel like maybe you don't want to do just 100% by yourself, there's a lot of ways that you can slice the pie and still get a bite and not be completely sidelined, which is what a lot of people forget. Like, there's so many ways. That's why I love commercial real estate. And I know you can't do this on your side, so I'm going to poke at this for a second. You can get as creative as all the minds at the table are willing to get in terms of how you can structure investment opportunities, right? Like, the stock world is, hey, this is it. Like, take it or leave it, right? Mm-hmm. There's no negotiating on this side. Whereas in real estate, which is why I think you and I always talk about these two things being very holistically synergistic, with they both can achieve great things by themselves, but if you find ways to compound them together, when things are great on one side, like yours right now, and they're a little bit boring and stale on my side, I've been extremely ecstatic with the gains and the growth that you've helped me achieve on the stock side. And when the real estate market, shifts and comes back and has its season again, there's going to be a lot of money that's looking to maybe diversify outside of the stock market world that is going to find great benefits of being exposed to real estate as well. So It's not one is better than the other. It's actually they can both work really well together when you do it right and you have a good plan and you've got good advisors.
Yeah, those are only that statement's only true in the short term, but really in the long term, like you said, the Symbiocy is data supported. They're the number 1 and number 2 asset class to have at no matter what you want to say. I don't consider businesses an asset class because you have to like run it. It's more of a entity that produces. But if I'm thinking of like touch
investment
it,
vehicles,
yeah. If I'm thinking to touch it, feel it, something hits my bank account, and I'm paying a fee for maybe through a property manager. Real estate and stocks have always been the top 2 for that, and historically show that. The third would be, believe it or not, bonds. But if you're looking for the top 2. Historically, all the way back to the mid 1800s, it's going to be real estate and equities, and U.S. based equities, not non-domestic equities, just vanilla U.S. stocks, vanilla, not even necessarily commercial, which that would probably increase those returns over time.
Yep.
Regular single family real estate, and just doing it right.
Yep.
That's the hard part, just doing it right. If you do it right and you have quality investments over time, you can build a serious amount of wealth in both of those.
Yeah, well, talking about kind of building wealth in real estate, one of the things that I mentioned this last week, I mean, you and I have been talking about it. I've been crying in my fucking beer for 2 years now looking at I got excited for a while, but looking at the 10-year treasury, it's been rough if you're a real estate investor or you're trying to leverage debt, right? We all know that, we've been in a rising interest rate environment over the last few years. I talked to so many people in the real estate industry, real estate investors, and it's been tough. I mean, don't get me wrong. It's been tough. There's still opportunities out there, but as easy as it was post-COVID when there was free money flying around, I mean, I think the lowest we saw the 10-year treasury get, let me see if I can pull up the 10-year treasury.
3.9, 3.8, maybe 3.6.
Well, in 2020.
Oh, I know. It was low.
2020 was 0.55.
Yeah, no, I know. It was way down there.
It was, so let me see. Let me go to all. So, I mean, if you look at this graph, right? No, let me get this out of the way. So, going back to 1981, the peak of the 10-year treasury was 15.8%. And look what it did over the next 40 years. You follow this trend line all the way down here to 2020, 0.54 was the low, 0.5.
Mm-hmm.
I mean, that's damn near free money at that point. And, all of the people that have been shouting from the rooftops for the last 40 years of buy real estate and hold, well, no shit. You can buy real estate and hold when you're in an declining interest rate environment for 40 years. You can buy it, hold it. You see property appreciate. You can pull cash out tax-free on a refinance and redeploy it, and that's the generational wealth building opportunity that so many people got the benefits of, and rightfully so, right? Because they did what? They took the risks that we were talking about.
Yep.
But guess what's happened since that trough right there? We've continued to see the 10-year treasury go up. And so over the course of this time, we've seen a lot of people who were of this rosy, kind of colored mindset that rents are going to keep going up and I don't need to do anything. I just need to buy. I just need to be in the game, right? Cap rates will stay, relatively strong and compressed. We'll see demand remain strong and prices will remain strong. Well, that didn't happen. And so what I am reminding people of as, a real estate investor is you right now need to not just be of the mindset that you need to get exposure to real estate investing and buy real estate, but you need to be of an operator mindset. Like you have to find ways to drive income now. You have to find ways of reducing expenses. You have to find ways of managing either your managers better or managing your assets better. You have to have an operator mindset. And the people who have those skills are going to kill it in real estate going forward, by the way. When interest rates do come back down, we're going to talk about that here in a quick second. Anybody that's holding real assets, especially real estate, is going to crush. And you're going to look back, especially when everybody, post financial crisis, when rates stayed where they were at, those people looked really smart and they didn't have to do a whole lot of, to get all those benefits. So I think if you can find a deal right now, they're still out there, and we'll see a couple little sound bites here in a little bit. There's big money starting to look at real estate again. There's big money starting to flow back into real estate again. But that being said, inflation is still somewhat of a concern. The Fed is still trying to navigate that. The Iran conflict, oil, all of those things don't necessarily help. What did we say before we checked? Interest rate probabilities were
it's a
75% chance of a pause in this month of July.
And like a 55% chance of a hike in September with like a 33% chance of a pause.
Okay. Now, we did get a good CPI print.
Yeah.
Was it last week?
Yeah, but now, I'm going to play, I got to play both sides of the coin. It's probably going to heat up a little bit because oil prices are high, but not back to where they were. So, again, it's not getting to higher highs, it's getting to higher lows. It's trending down. So to me, yes, oil prices are up, but we're in the mid 80s. The market is moving in the face of that. If we can get that capped and have it continuously trend back down or stay in this zone, I don't see it affecting CPI data as much, but it certainly will affect CPI data because the opposite happened where it was in the 70s, and obviously that's why we had that big turn down.
Yep.
So time will tell, but I'm anticipating that traders are going to shrug it off.
And you're still of the mindset that we're not going to see hikes this year. We're just going to see pauses through the remainder of the year?
Yeah, I want cuts so bad. But yeah, the data doesn't support really either. Even if the futures say one way, this way or that way, there's not enough concrete data to make a decision that would be that would meet the Fed's mandate for them to cut or hike, which is unfortunate because I want them to cut. But they definitely can pause, and pause they will, and I believe they'll continue that. We'll know in a week when we hear Fed Chair Warsh speak, if he gives any indication, but per his new rules and how he's running things, I don't think we're going to get much.
Yeah. I'd love to see some rate cuts, but it's going to be I think we're going to have to do we're going to pop some champagne or something when they start cutting rates again, because it's been way too long outside of Powell cutting in November right before the election with 50 basis points, which still is a shocker to me. Before that, it's been a grim couple years if you're trying to leverage any kind of debt in real estate. But still
brutal.
It's been brutal, but still great opportunities. All right, so take me over to earnings season real quick. Obviously, semiconductors, stocks.
Popping again. Yeah, semiconductors, AI, big chip names, Tesla. Tomorrow is going to be, or I guess, if you're listening to this live tomorrow, if you're listening to this on the podcast today, huge earnings day. Google, Tesla. I would love to hear some chip production news from Texas Instruments.
Yep.
It's a very, very strong day for earnings, and this week has been strong, and the companies that have been reporting good earnings, giving good guidance, really good earnings calls with their investors. So this is the type of earnings season that you want to see moving into the holiday season.
What are your thoughts on we talked about AMC a while back, and AMC just reported strong earnings. Didn't they have a 28% pop on at post earnings? And do you think that's just because
I believe they did.
IRL in real life?
People like going to the movies, and I think that they did good with their membership structure, where it's like a flat fee, get a certain amount of it. Same thing like at a bowling alley. It's like, do you want to pay $20 for shoes in a game, or do you want to pay $25 for unlimited bowling? Well, yeah, $25 for unlimited bowling. That same idea with AMC. Do you want to, do we want to make it a task for you to get a ticket, or do we just want your ass in the seat? Well, we just want your ass in the seat, and we'll make our money on concessions like they do. So very smart, very, very, very smart. AMC and GameStop. GameStop perfected it better than AMC did, but two meme stocks that actually turned into real functioning companies. Not that they weren't functioning companies prior to that, but I think both of them were expected to go defunct. They were heavily shorted, not a lot going on the balance sheet for either of those, and then the brigade came in and saved them all. They just wanted to buy the stock. They liked the stock.
Yeah. Okay, so a lot of people have been following SpaceX. You know, their $1 trillion IPO, or multi-trillion-dollar IPO. SpaceX, and this was as of the 18th, so we're 3 days ago, has erased $1 trillion in market cap over the past month. We picked up some StockX.
SpaceX?
Or, yeah, StockX.
StockX, where you shot, baby.
SpaceX. Where did we pick it up? We were like 134?
148-ish.
Okay. And 134 is where it IPO'd?
No.
Or was it 140?
I don't know where it IPO'd. I honestly can't remember.
But either way, what are your thoughts on the pullback that we're seeing there? And does this project some
135.
135. Okay, so yeah, 134, 135. With this pullback, like, what are your thoughts on how this impacts how other big, potential $1 trillion IPOs are going to fare, as we've seen kind of, SpaceX got to the starting line first. We've got OpenAI, we've got Anthropic, we've got, many other potential close to $1 trillion or if not $1 trillion IPOs. Are we going to see something similar to this? And is this pullback going to hurt their IPOs going forward? What are your thoughts?
I think that it's really going to be industry dependent. I think SpaceX is obviously going to be a real game changer.
Oh yeah, it's going to be successful long term.
It'll really
sure.
catch on. The thing I see that's kind of worrying me about OpenAI is that just like ChatGPT is not as popular as it even was 6 months ago, and so they're really going to have to figure out a way to get their penetration better, in my opinion, because there's a lot of AI models out there. Claude has done very well catching up. Grok, which I primarily use, does really good. So I am more so interested in things outside of I like space. I think space is the SpaceX one, even though it's already IPO'd. That, to me, that is the more interesting.
That's the IPO of the year?
Yeah, because there's a ton of AI companies. There's a lot of companies like Microsoft that can just do it, and they're already big. And Apple, NVIDIA,
yep.
A lot of these like proxies. There's like one SpaceX.
Yeah, they're the category king for sure.
So look at Tesla.
Yep.
I have a feeling it's going to be a similar story. Will there be a Blue Origin? Probably. Will there be? Yes, but everybody's going to, it's not a Kleenex.
They're going to know who Daddy is.
It's not a Kleenex. It's a tissue paper.
Yeah.
But you call it a Kleenex because that's the brand you recognize for the product.
That's very true.
So that same idea I think is going to happen with SpaceX. And it's very, they're going to be early adopters. They're going to lock up all the early government contracts. It's going to be hard for competitors to improve upon their product because it's a pretty finite product too. I mean, you safely get into space. You do it for a low cost. You return back down to Earth. There's not a lot of things to improve upon there. So once you do it, you can already do it. The risk of trying to find a replacement for you is too much. And so, again, I think SpaceX is going to highly benefit from that long term. Don't know what's going to happen in the short term. Excited that some of our clients own it. And I believe that long term they'll be successful.
Well, the main news in crypto is that the Crypto Clarity Act, a lot of the provisions in that act, which Democrats, Republicans have been kind of, going back and forth and debating on for the last, there's been so many iterations of this bill. The White House signed off on it, which was a big deal. And the Democrats agreed and signed off on it as well to move that forward. So it seems and feels like we're getting much closer on the Clarity Act to get passed.
It's fourth and inches.
And
4 inches, and we're almost there.
I mean, my opinion of this is, and we've been talking about this for some time. You've been saying it for years. What did you say before the show started?
Oh, I said the same thing that people argued that was going to kill crypto is the very thing that's going to save it. People were arguing me for years. I mean, if you go back on this podcast 5 years back, you will see me saying we need regulation and legislation. It has to be regulated or nobody's going to adopt. This is pre-ETFs, pre-grayscale, pre-all of that. I've been saying it for years, and everybody's argument to that, not necessarily just to me, but to that statement was, oh no, regulation is the exact thing we're trying to avoid.
It's anti-crypto
community. You know, fast forward, those same people are those motherfuckers.
They're the
same people that are like
that shit now.
Come on, BlackRock, dump all your money in. They're the same because that's what's moving the price.
Yeah,
and like I said before as well, the only reason people buy crypto is so the price goes up. I don't buy any investment so the price doesn't go up. I don't know why that's like a dig on you. It's not a dig on anybody. But stop trying to act like you're smarter than everybody. Like, oh, I buy Bitcoin because fiat. Shut the fuck up. It's literally not going to replace the dollar. So that argument was out the door day one. I've been saying for years what was going to be institutionally adopted. Say it with me. Ethereum. And guess what's getting all the money? Ethereum. That's where all the money's going institutionally. I know it hasn't taken off. I know Bitcoin is still the one, and people can hate on me. Bitcoin is probably not going to be what it is now in the future. It's not. I'm sorry to my Bitcoin holders. I'm looking at one right now.
Mm-hmm. You are.
But I'm not this big Ethereum. I don't have a lot of Ethereum. I literally have like 2. So I'm not here going to make a lot of money if it goes AWOL or anything. I'm just telling you that's where the institutional money is going because it's it's something the ERC can actually be developed on.
Yeah.
You can't do anything with Bitcoin.
Yeah, there's a lot of...
It's the most frustrating argument I've ever seen in my life. That
Yeah, you've been beefing with Bitcoin holders since inception.
It doesn't do anything.
Yeah.
Yeah, it quite literally doesn't do anything. The only thing it does is it has scarcity. So the price pumps really hard. It's like a floating short squeeze waiting to happen constantly because the scarcity is so much. But the problem with that is you get people like Michael Saylor that accumulate that much and then they can move the market. That's not good. I don't know. Again, the same people, you know, a lot of the crypto community are liberal. I still love you, but they are. And the same people that talk shit on Vanguard and Fidelity and BlackRock for accumulation of assets when it's not even theirs. Oh, they own 7% of Chevron and all that. Bro, Michael Saylor owns like 10% of Bitcoin. You're like literally choking on his, you know what? Like where's the balance? Nobody, it's so frustrating. It's there. It's like, it's okay if it happens in Bitcoin, but it's not okay if it happens anywhere else. Even though it's not even happening as bad or in the same way. One person should not own that much of an asset. It's not responsible. It's not. Why do you think you get boned so hard at the casino? Because the house controls the odds. That's what happens. I don't get how it's dystopian that people would want to like invest in something like that and want their money to work something the way like that. So it frustrates me to no
But you
end.
do love Ethereum. You love Sol.
I love Ethereum. I like Solana. I like Ripple. I like World Liberty Financial Group. Papa Trump, pump it. I like all of that stuff. You want to know why? Because I have no emotion when I invest into it. I'm very certain that all of those, a long period of time, will make me some money. Well, but I barely put any money into any of them. So if they don't, I don't care.
A lot of them have been accumulating, you know, and kind of finding their base here, and they haven't experienced as extreme volatility, and there's real utility
I would say there's
and
like no
projects
utility
being
in
bought.
Liberty, but the
they're
Trump
more of
family,
like just
the Trump family
yeah.
is involved with it. And if you don't think that they're going to make money in the crypto space, you do.
Well, he's already. What did he? However many
report.
trades he disclosed, and he's already made a bill in crypto.
Other people get all mad. Oh, Trump made money, and then fuck, Nancy Pelosi's made hundreds of millions. Like where again? I just don't. I don't get it.
Well, I think that no matter how you feel about a certain project, right? I think just from a macro perspective about the space is that the Clarity Act is going to be macro bullish for the entire crypto community.
100%. Bitcoin included.
For all
I'm fair.
There
I'm
you go.
honest.
For all the people that have been feeling like it's too risky or it's too volatile or it's,
still super early.
It's very early.
Yeah. Super early to crypto.
That if our government, because they've talked about it for quite some time, in past administrations too, this administration specifically wanting to be the leader that is helping create the legislation and make the United States the crypto capital of the world. Because this is the future of finance in many ways.
100%. Our financial system is so long in the tooth. It's ridiculous that we have the volume of money that trades in our
way it still does. As it has for so long.
Crypto is going to be awesome for the financial system.
Yep.
Just in a different way than people have been saying it. It's not going to replace any dollar. I told y'all that all the banks were going to get together and copy a central banking currency,
which
like what they just announced last week. They're just like, hey, we're not going to use any of the ones that exist. We're all just going to share this one, just like we do with a dollar with the U.S. Treasury. It's too easy. That's what I said. I need to get it tatted.
Well, yeah.
I literally need to
get that shit tatted on your chest.
Easy.
But at the same time, this is where I'm getting excited because I do think, and I don't know, have we hit a bottom because now we're getting closer to feeling like this regulation and legislation is going to get passed?
Let's just do this. It's going to turn a page, and then when the next chapter of volatility is, let me tell you, my children, which ones are going to work and which ones aren't going to work. Because now people are going to make a decision. You're going to see all these projects fail.
Oh, yeah. There's thousands and well, shit. If you just go on like Pump Fun and the meme coins, I think there's tens of thousands of projects
those are going to go
that are just like they're dog shit. They're useless, right? But just like the internet gave so many people a platform to create a business or an opportunity to monetize something, but most of them failed, and the leaders rise to the top by creating real value, having real utility, having real infrastructure, having real, right? Like, you can't just think that because there's legislation in the space now that everybody's going to benefit and win. No. But it will help us identify the ones that do have really great theses, really great teams, really great infrastructure, real world utility. Those ones have massive upside, I think, to really showcase themselves over the next few years with this legislation coming into play. So I'm really excited about it. And obviously, we've got trillions of dollars sitting on the sidelines that ideally are going to be looking for undervalued opportunities. And the crypto space is one of those spaces that I think will be a beneficiary of it.
Yeah, I would say over the next decade, it would be tens of trillions of dollars that would go into the crypto space. Crypto and AI have some sort of unspoken relationship we don't know about yet, but we do. So there's a lot of excitement to go on with the crypto space. I couldn't tell you exactly what it's going to look like, but my anticipation is increase of efficiency, increase of speed, increase of transparency, lowering of cost, and hopefully with institutional adoption and regulation, increase security so there'd be less fraud, which is another form of cost to regular investors. It's an overall win for everybody, including the system that runs it.
Yeah, for sure. Well, I am very excited to see... there was a really cool podcast recently. Let me see if I can find it. Around many investors sitting on their hands and slowly starting to come back into the commercial real estate space. We're starting to see a pretty healthy amount of capital starting to flow back in, right? Which is just like on your side, right? You just follow the smart money, see where they're going. They're usually going to be the ones that front run opportunity. I do think that we're starting to see some early signs of maybe the real estate market on the commercial side starting to take a little bit of a turn in a positive direction, hoping that, of course, rates continue to move in the right direction. But also, I think there's just been this season of people sorting through all the shit that came post 2022 rate increase environment and all of the syndicators and deals that got cut underwater and all the headwinds that ultimately hit commercial real estate, rising insurance, rising labor, rising material costs, rising debt. All of those things really, trapped a lot of people in assets that couldn't get out of them. But at the same time, there's a lot of dry powder that has been sitting on the sidelines that has a mandate that needs to get put to work that hasn't. And so we're starting to see people explore what those opportunities are right now. I'm trying to see if I can pull this up. So this was Chris Powers is a guy that has I think it's like Powers Podcast or something like that. He interviews really cool. If you're anybody that's interested in commercial real estate, not everybody is, but if you're interested in people that are commercial real estate assets and investing, I love to follow the big names because they have always got the best data. This guy himself, Mark Gibson of JLL, which is one of the largest commercial real estate firms, he is a data junkie. And so he talks about in this episode, maybe it's couple minutes. Let's see if we can give it a couple before we play this real fast. But basically what he says is, the first is capitulation. Let me pause this real fast. Investors who never got their money back are done waiting. We need the capital back. We want to redeploy. That shift is showing up in the numbers. That is happening at scale in the marketplace, which is why you see transactional volume in the U.S. rebounding. It's up 26% relative to last year. That's a pretty big deal. I mean, it may not seem like it's a big number, but when you're coming out of really I don't want to say a depression, but you're coming out of a trough and you're somewhat on this recovery uptrend a little bit, these initial numbers like this 26% year over year on transactions in the commercial space is something to pay attention to. He also goes on to say the second force is the opposite emotion, which is conviction. You have real conviction from investors that now is the time to go play in the commercial real estate business because of the relative value argument. So he kind of talks a little bit about this. Let's give it a listen and we can kind of unpack it here in a second.
Conviction or capitulation?
It's both.
Okay.
Go back to a statement you made, and I commented on that. Some of the investors that you've been hearing from, they just haven't gotten their money back. Whether you're a retail investor or an individual investor or an institutional investor, it's similar. And so if you don't get your money back at what you thought you would get your money back, then it's hard to go redeploy into it, depending upon the source of capital. So when you think about some of this AUM aggregation cynicism that I mentioned, meaning extending funds and not giving capital back, that's part of that.
Basically, people
concept where
stuck.
You have investors that are now becoming frustrated, and they used to go along with hanging out and doing what they were going to do. Now they're mandating, no, we need the capital back. We want to redeploy. And they're going to redeploy because they may have a different strategy. They may have a different GP that they want to invest with. They may want to be direct, to your point, or they may want to go into a different fund vehicle. There's all kinds of reasons. But that is what we call capitulation, where the investors are now saying, no, here's market. We've played this out over a period of time. We didn't sell at the absolute bottom. And we think this is a stable environment, and we want our capital back because we think we can reinvest it and get a higher return versus where we are. So that is happening at scale in the marketplace, which is why you see transactional volume in the U.S. rebounding. It's up 26% relative to last year. So just as an example of that playing out real time. On the flip side, as I mentioned, you have real conviction from investors that now is the time to go play in the commercial real estate business because of the relative value argument that we started with. And they're looking for the cash on cash component. So anytime you have a seller at market and you have a convicted buyer of coming in that I'm really convicted to invest in the asset class, then you have transactions that occur because they'll meet at the market. And so we've seen the bid-ask gap narrow as a result, and you see more transactional flow occurring.
So my takeaway from that is, especially post-COVID, we had a lot of retail people get into syndications, get in funds, get in assets in commercial real estate that they never, ever explored before 2020. They were not.
Agreed.
I mean, the amount of people I saw raising capital, syndicating deals, acting like, I mean, there was doctors and dentists and fucking people that I didn't even know were in real estate or even knew about commercial real estate were doing syndications and raising funds. And they got a lot of people in their immediate environment and ecosystem involved in commercial real estate. And there was a lot of people that had no business being in those types of investment vehicles or opportunities. And those people were retail. Mm-hmm. And now they're somewhat on, to relate to your side of the world, they're now somewhat becoming exit liquidity for the smart money that was like, nah, we see what's going on over here. Like, yeah, they were picking and choosing, but they obviously have deeper war chests beyond the retail investors. And that's why we saw so much capital flying towards so little assets, which inflated prices and things went bananas. And then when the shoe dropped, those smart money investors were not investing. And if they had to ride it out, they had the war chest to float themselves over that time frame. So they didn't have to sell. They didn't become forced sellers like many people have been over the last few years, or over the last year at least, which is what we're starting to see the transactional volume tick up like he's talking about. People are like, hey, can you get me any of my money back? Can I get a little bit of it back? Like, can you just get me out of this thing, right? So many, beat up, scarred, investors, LPs, operators. And guess what we're seeing? We're seeing smart money come in based on that exit liquidity, and they're going, yeah, we'll scoop that up off your hands. We got that, right? Because they know what the next season and wave, this is my thesis, of investment opportunity is going to look like over the next few decades. And I think commercial real estate is going to see itself start to rebound. And we're going to see some real capital flow into the space here over the next decade, especially as we see other asset classes maybe plateau or have little pullbacks. Commercial real estate has been down in the dumps. It's held its own. But if you've been investing in real estate, in commercial specifically, or just in general, you know what kind of struggle your investment partner has been going through, or your fund has been going through, or your GP has been struggling with. And I think that there are brighter days ahead here. And it's data like that gives me little tiny insights into my crystal ball of where do I think the real estate market is going to go. And I do think that, we're starting to see little tiny shifts here. If we can just get rates to kind of come back in line with where economics of deals make a little bit more sense, that risk reward ratio kind of falls back in line, I think commercial real estate investment opportunities are going to be looking really great for the next few decades. Of course, there's always variables and nuances to every asset class, every market that you got to take into account, who you're investing with, the team, all those kind of things. But very exciting times for real estate, in my opinion, over the next few decades. One thing that I thought was really interesting, maybe we'll wrap up on this. There was an interesting kind of thread and some comments that were made on a stream that I was watching, actually. And I was curious on your thoughts on this. Somebody had noted that, and we're seeing a lot of shifts happen in social media right now. I don't know if you're seeing it, but do you feel like you're seeing like the people who are kind of, the type of content people are making and how they're making it, the stuff that used to be like all the eyeball attention grabbing stuff, more entertainment stuff, is now becoming kind of more educational based, and how people are delivering that content, it's becoming a little bit more authentic and, I don't know, maybe less polished, less fake. It seems like the pendulum is kind of swinging back a little bit, but somebody had kind of, and this kind of ties into a prediction that I'm making. This person was saying that they think finance and wealth building influencers are going to become like somewhat bigger public figures and kind of more influential than call it the pranksters and the YouTubers. Yeah, I was thinking about you in your space, right? I was thinking about me building in my space. I'm thinking about the Graham Steffens. I'm thinking about the Caleb Hammers, the people who have really been trying to educate people on building wealth, and not just the people that like are just teaching you how to spend money. Go on this trip, buy this shit from me, do that. Like people actually trying to bring real value of whether it's adding something to your business that's going to help you make more money, or it's learning how to invest in stocks, or it's learning how to trade crypto, or it's learning how to invest in real estate, or whatever, managing your personal finances, how to build a net worth. Caleb Hammer just hammers people on get your fucking financial house in order. Like, why are you spending money on that shit? You really want to build wealth? Do that, Yep. And those people are blowing up right now. Mm-hmm. And it kind of, to me, my bold prediction is that these types of influencers, now mind you, there's bad apples in every bunch. You can't take everything that somebody says at face value. You got to do your own research. You're not financial advice, right? But at the end of the day, I think what I'm seeing is based on where a lot of people's attention is going, people are seeking more ways to unlock freedom in their life, and they're understanding how critical it is to be financially literate. And it's kind of become, I'm like, let's make finance cool again. Like, can we start to figure out how to lift the people up that are really helping individuals build wealth, get their financial house in order, build real financial skill sets, learn how to invest? Like, because that's ultimately what I think younger generations are craving terribly too, right? Is they want freedom. Well, only way you're going to get freedom is you better learn how to make some fucking money and manage
Fun
your
coupons.
money. So I just thought that was cool. My prediction is that we're going to see financial and investment and wealth building influencers really blow up over, I think, those streams, those, videos, the YouTube channels, the individuals making shorts and reels. I'm bullish on those people. I'm curious on what you guys think. Let me know in the chat. What do you think about that?
I think that that's probably going to happen because people are realizing that they can get value from certain individuals in that space versus just wasting their time and getting nothing from it but some short-term entertainment. So I agree with that.
Yep. All right, we're going to wrap it up on that today, guys. As always, we appreciate you guys tuning in. If you want to connect with Ryan and his team, we get y'all that
come on
reach
over,
out
man.
Each and every week to, you hear this fool spout off some level of brilliance, and every once in a while a few zingers that make you go, ooh. If you want to connect with him and his team, all you got to do is text the word XRAY to 844-447-1555. When they do that, just what does that process look like? What can they expect? You guys text that word.
Typically, my assistant Phil will reach out to you. He will get us scheduled for an appointment or send you my calendar link to schedule an appointment. We just talk. It's really me. It's not like somebody on my team. I will personally call you, have a chat, see if there's anything I can do to enhance what you're currently doing. Most of the time there is. Most of the time there's something that can be done. We'll take the time figuring it out together. There's no cost or obligation. I don't make you sign anything. So it's very easy, very transparent. You get a full financial plan out of it.
It's a cool process. It was very eye-opening for me. And I know you've said this before too. Like, the biggest thing that you see when people reach out to you is that they're just getting way overcharged.
Yeah, or they're taking way too much risk and not getting enough of return for it. That's typically the two things we see.
Cool. So yeah, if you guys want to reach out to Ryan and his team, XRAY to 844-447-1555. I know many of you are either active real estate investors, passive real estate investors. We got a lot of high net worth, high earning people on the show too that are just looking to continue to generate more income passively. We've got the Imagos Income Fund. So if you want to partner with myself on basically we lend money out at a high interest rate, and we pay you guys out 10% per year, paid monthly. And if you're interested in learning more about that, it's a 506C Reg D credit investor only fund. But if that is of interest to you and you want to learn more about generating some additional passive income, you can text the word income to 844-447-1555. Been able to connect with many amazing viewers and listeners that are in the fund, that are getting monthly mailbox checks from us. And if you are more interested in being on the LP side, you're interested in kind of the equity component of it, and, being involved in the deal still passively, but, being on the ownership side of the deal, not just lending out and being in the debt position, you can text the word deals to 844-447-1555. And that'll get you on my accredited investor list. If you're a accredited investor and you want to know more about the investment opportunities, we're working on medical office building right now, another shopping center. So there's still deals out there no matter what people are telling you. But finding the right, again, like I mentioned earlier, operator. You have to have somebody that, whether it's me, somebody else, there's some great operators out there. There's even more terrible operators. So just be smart. And invest with the right people. But if that's of interest to you, text the word deals 844-447-1555. As always, we appreciate you guys. Keep investing in yourself and your wealth on your march to $1 million and beyond. We'll see you in next week's episode.
Cheers, y'all.